Hi, sir. Good evening. Good afternoon. Sir, please unmute yourself.
Good afternoon. Are you able to hear me?
Yeah, you are audible now.
Okay, okay. Uh, okay. So should I should we wait more?
We can wait for next 5 minutes so that if the participants who are willing to join, they can join us. Otherwise, the session is going to be recorded and they can look upon all the things over the YouTube and can directly reach you out.
Okay. So when I will speak, can I be on the full screen?
Yes, you can be on.
How?
So, how are you, sir?
Um, I'm doing fine. I just wanted to know that when I speak, can I be on the full screen?
Yes, yeah, you are on the full screen.
Oh, okay. To me, it is showing different windows. Hello.
Then you can just give me a minute. You are being asking at the moment when you have to share the PPT?
No, when I'm speaking, like I'm speaking right now.
Yes.
So when I'm speaking, I should be on the full screen. ना वो automatically आ जाता है.
Yes. We can pin up your session.
अच्छा.
So shall we start so that and in the middle of the session people can keep us joining?
Yeah, that is okay, but you didn't tell me the solution कि जब मैं बोल रहा हूँ, how can I be on the full screen? Recording के time पे भी. ये
Uh,
अभी जो दिख रहा है उसमें विंडोज छोटी छोटी दिख रही हैं बहुत सारी.
okay. So I'm not getting it what exactly you are मतलब asking.
मतलब जब अगर presentation हो रही है तो presentation will be on the screen,
Right.
and when I am speaking then I should automatically come on the full screen.
Just give me a minute. Let me ask a technical guy.
Hmm.
Sir, I had a word with the technical people. They are saying that Google Meet do not have this particular feature. When you are presenting your screen, only that particular screen is visible, not you. मतलब it is going to be visible for us, but not to you.
तो वो जो रिकॉर्डिंग होगी उसमें विंडोज ही रहेंगी मतलब.
What I'm going to do is कि I'm going to pin up your image on my screen. So जब सारा session record होगा तो वो आप एक bigger screen पे आप show हो जाओगे.
ठीक है, करें शुरू.
Hi sir, good afternoon. So before we start the session, let me give a very brief introduction about our today's speaker. Mr. Tushar Kansal is the founder and the CEO of the Consultancy Venture. He has accomplished professional thought leader and a thought influencer over the years. He has supported startups and growth stage companies in diverse tech and non-tech sectors. He is being awarded as a best startup supporter by India First Expatriate Conclave. By profession, he is a venture advisor with Loyal VC, the in seed led Canadian VC fund. His expert opinion is often sought by leading businesses, new channel, publication like CNN News 18, VCTV. He has come on 200 plus talk. Google him or check him. We can over the YouTube as well. He aims to help change maker by means of venture capital and strategic services, leveraging 450 plus investor or VC funds, connect and picking up sector, agnostic global deal. He received executive education from Harvard Business School and MBA in finance from University of Delhi. We welcome you, sir, for our today's session with us.
Thank you, Shivani. Thank you, Eduroutes, and thank you all of you for being a part of this uh, presentation today. Today we are discussing the role of finance professionals in the venture capital ecosystem, and which includes the startup ecosystem. So I will begin by sharing my slide, my presentation. So are you able to hear me, see this, Shivani?
Yes, sir.
Okay. Are you, yeah. So venture capital is one of the fields within finance space. Finance includes a lot of financial services, and if you are a company, you need a lot of financial services. And there are many types of organizations who provide these services. So within a company, the department which handles the finance is called corporate finance, and they handle all the activities like raising loans, raising equity, like forex transactions with the bank, like investing the surplus money, like opening letter of credit, bank guarantees. And then there are financial services companies which help the corporate achieve all of this, which is mutual fund, which is insurance company, stock markets, and investment banks, and the regular banks which provide loans of different kind. So venture capital is a niche field, which means that if you are a venture capitalist, you take money from limited partners, LPs, and you deploy that money in different startups and different companies, so that once the companies grow big, you can sell your stake in the company and then make a profit, which is called capital gain. But everyone wants to work in venture capital field, but not everyone is able to, because venture capital is a very niche field and it requires a lot of expertise. So how can finance professionals aspire to work in venture capital? Today we'll discussing this today. So this is about me, which Shivani has already very kindly given a beautiful introduction. So I'm really thankful to her. Now, if you understand uh, how funding happens in a company, when a company is started, then you take money from friends and family. We call it FNF. And then there are certain individuals who will help you with their money. So these individuals are called angel investors. Now, after the company becomes stabilized, so there are different phases in a company, like proof of concept, minimum viable product, and then product market fit. So once the product market fit is achieved, we say that the company has stabilized, so it is ready to grow. And at that stage, venture capitalists come in and they invest significant amounts of money. So mostly these are early stage venture capital funds. There are many late stage capital funds also. Mostly they are called private equity. And then a company has to provide these investors an exit from their shares. So the company has to find further buyers of these shares, or it has to do an IPO on the stock market so that the initial investors can sell those shares. Now, these are the financing options which are available. For example, angel investors, as I told you, are today everybody is an angel investor. After seeing Shark Tank, I was a shark in a Shark Tank competition at IIT Delhi. And if you look at a student is an angel investor, a person working in a private limited company is an angel investor, a housewife is an angel investor, an industrialist has become an angel investor. Everybody wants to invest their money and make a profit from it. So then there are angel networks and platforms like Punjab Angels, Indian Angel Network, like Mumbai Angels, FARD Network, and many are there. So they basically help angels invest their money in a standard format so that the deal happens properly and all the paperwork is proper, and all of them can invest under a similar kind of conditions. Then the other one is venture capital funds. As I told you, they invest in early stage and late stage. Nowadays, they when it is the early stage of the company, that time the requirement of money is the most. So nowadays you have micro VCs. So micro VCs are those who invest in um, small fund size. Usually they are 60-70 million dollar kind of micro VCs. Now, if I were to ask you a question, uh, you know, uh, there is pre-seed round, then seed round, then Series A round, Series B. So these rounds happen. So a pre-series A round in a startup is likely to be of what ticket size? I'm just making you think big, think critical. So the answer is one USD 1 to 2 million. A pre-series A round in a startup in India is likely to be USD 1 to 2 million. And nowadays, Series A rounds are becoming bigger also, even more than $2 million. But uh, that is a long-term trend. In the short term, the markets are a bit tight nowadays, with Silicon Valley Bank going down, and also Russia-Ukraine war and those things. Now, there are corporate venture capital funds also. Basically, they are large multinationals that invest the money of the corporate into startups. And there are venture debt funds also. Basically, instead of providing equity, they provide loan, they provide a debt. And startups typically cannot give any collateral. Like Banco, you have to give real estate or shares. So venture debt funds are those funds who provide funding to startups, and they make a interest rate on the loan they give. But apart from that, they need extra return because they are taking a lot of risk, because startups are risky, they might close down. So the venture debt funds, they take a upside on the equity also. So whatever equity uh, is there in the company, they might take some warrants, convert it later into equity, and then sell those and earn some extra money. Then there are government grants and funds. As you know, Startup India program, Invest India program, they are there. So usually the money given by Government of India is 15 to 25 lakh rupees. I was a judge in a business school pitching competition in Switzerland, and the top three startups were given uh, grant funding. Not even the government did not even take equity. It was grants. The funding given by the Switzerland government to the top three was roughly about 4 crore rupees each, and the pitching session was hardly 15 minutes. So one of the companies was an Indian company, so this guy was really happy getting 4 crores for nothing and trying the new business. So they were encouraging the B school students to take risk, use government money, take risk, form a startup. Next, if I were to ask you a question, what can be the hygiene factors which a venture debt fund usually considers before making its debt investment decision? So hygiene factor means that these things should be there. Otherwise, we are not considering the case. They are the bare minimum. So venture debt funds are very cautious. They will not just give funding to any company. So there are certain basics they see. First of all, startup should not have a solo founder. All these four options are correct. The answer is all the four. Startup should not have a solo founder. The startup should be already funded by external equity investor. Third, startup should be on a great growth path. And fourth, the cash flow of the startup should support the interest, or we call it the coupon payments of the debt instrument. So these four factors are seen by venture debt funds. Now, more key financing options. Accelerators and incubators are there. These are basically vehicles which help you set up your company. They make you meet industry people. They make you reach out to business from their contacts. They give you office space, sometimes Wi-Fi. They provide you cheap chartered accountant, CS, legal. And in India, the accelerators usually give between 15 to 40 lakh rupees. And they take between 3 to 8% equity. So they help you set up initially when it is the riskiest, and they take some equity and they provide you some funding also. We at Consultancy Ventures are networked with almost 38 accelerators, incubators. We have agreements signed with them. Then we have family offices. Family offices like Azim Premji, Wipro, Anirudh Damani, like Gaurav Burman of Burman Family Office, like, Loda Real Estate Group in Mumbai. Their family office is called Tomorrow Capital. So they basically, whatever family owns the business, whatever business is owned by the family, they take money from that and they put in companies. Largely speaking, family offices don't have the bandwidth to understand businesses other than the family-owned business. So they usually put in money in the VC fund. They put in a fund guy then invests. So they become fund of funds. Then banks, Silicon Valley Bank went down 2 days, 3 days back. It was providing the largest provider of capital to venture capital funds, and also to Silicon Valley startups. So startup venture capital banks are not many. Banks typically like HSBC and Kotak, they have some schemes for startups. So they help the startups with providing technology and cloud-based solutions. And they want the startups to open their accounts in their bank, because when the funding happens, then the banks have a lot of float, lot of money lying with them of the companies. So and the crowdfunding is, there are platforms where people can invest small amounts of money, and a lot of people invest small amounts, and then the company raises money. Now, one question: how many accelerators does India have as of end of 2022? 250, 500, 750, or 1000 approximately? So the right answer is approximately 1000. There are more than 1000 accelerators today in India. Now, continuing with key financing options, revenue-based financing is a new type of financing in which, suppose you are a D2C company, direct-to-consumer company. You are selling consumer items online through your website. You have a payment gateway. So people buy your products, your revenue comes on the payment gateway. And you are a company which is quite set. You have the warehouse, you have the team, you have everything. So the revenue-based financing company will give you a loan, which is called revenue-based financing. It is usually 1% interest rate per month. And they know that the company is set, it just needs marketing money. So their money will go to marketing, and the sales will increase. So the money coming to payment gateway will increase. So what they do is on the payment gateway, they put an escrow. So uh, from the payment gateway, first their interest and principal comes, and then the rest of the money goes to the company. So their payout is assured. Suppose they gave 1 crore, they are charging 1% per month. So 1% every day they will every month they will cut from the payment gateway. Um, every day the money will be coming from the payment gateway. They will keep on cutting their 1% thing and the principal also. The companies in revenue-based financing are Club, GetVantage, and there are others also. Now, startup funding stages I have already told you. Question is, revenue-based financing is most suited for which type of companies? Artificial intelligence and machine learning startups, consumer startups with online platform, old economy financial services firms which want to migrate to online, or brick and mortar retail chains. So the right answer is two. It is most suited for consumer startups with online platform. And the reason is they have a payment gateway. And secondly, the money which they give revenue-based financing, it goes for marketing and sales. So the revenue increases, the sales increase. So they take money from that. So it is more suited for consumer startups with an online platform. Now, what is the hierarchy in a typical venture capital fund? As in, how is the team there? So you know that the person who manages the fund, who decides where to invest the money, is called a general partner, GP. And the people who put in the money in the fund, they are called LPs, limited partners. Apart from that, they have a principal. Principal is the guy who heads the team. They also have a CA. They need a CA, right? And in many cases, they have a CFO also to manage the money which they have raised. Then they have an analyst, which makes the calculations and he does all the research. Then there is a pre-MBA associate. There is a post-MBA senior associate. There is a principal, as I told you, and there is a junior partner and a senior partner. Junior partner is the next general partner. He's being trained. And most of the decision making happens through an investment committee in which the GP, the general partner, is there and the limited partner is also there. And the principal is the one who presents the case to the investment committee. Now, in venture capital, as I told you, there also is a CFO. See, you raise hundreds of crores from limited partners. So that money, many times, rather most of the times, it comes in stages. So the LP will say, take 10 crores first, invest this, then I will give you more. And so, that money, when it is coming to your bank account, you need to manage that money. You need to put it in a safe place, like a liquid fund or a fixed deposit. So, and basically, uh, the fund deducts 1.5 to 2% of the corpus it is maintaining every year for its expenses, for office expenses, salaries. Har saal, 1.5 to 2% they deduct. And when they make an exit from the investment, whatever capital gain they have made, they deduct 20% of that. But there is a hurdle rate. Hurdle rate means they are promising 8 to 9% return without charging anything on that. Above that, whatever is the extra return, they charge 15 to 20%, usually 20% of that. Now, CFO responsibilities are given here. They have a huge KPI. So they need to handle the cash flow. They need to work with the CFOs of portfolio companies. They need to know which company is performing how, what is the cash flow of that company. They need to oversee the firm's annual budgeting. They will have to do the due diligence of the companies in which they are investing. Then due diligence means finding out the corporate, the legal side, the accounting side, the compliance, the statutory compliance of each company, the background of the founder. They need to find out. Now, question is, which designated team member working in a VC fund is most likely to be on the maximum number of external calls? Means that who's the most busy in terms of handling the calls? Principal, general partner, analyst, or CFO? And the right answer is analyst, because almost in a good fund, almost 20 to 30 startups approach that fund every day. And all those data is there in front of the analyst. He has to be on the calls and understand each company and present the case, make a case for the investment committee. Now, more careers in the field. As I told you, they need accountants and auditors, and they need analysts, and they need venture capital associates. They need investor relations specialists, so people who maintain relationship with limited partners, because limited partners money is there which is being managed. And they also need to build relationship with other investors, because suppose today you invested in a company. Now in the future rounds of the company, that company will need other investors also. So you have to make relationships with other investors also. Then they need marketing specialists, people who uh, promote the company in the best educational institutions, promote the company in the best places from which quality companies come out, like T Hub, Hyderabad, the incubators at IITs and IIMs. So you need marketing specialists. Then you need lawyers. It's very important. Lawyers are needed because you need to sign the contracts, which are the shareholding agreements, and you need to sign the contracts with limited partners also. So you need to sign all these contracts. Now, you need, as I said, there are venture capital principals, basically who manage the team. There is venture risk managers. They identify, analyze, and they seek to reduce or eliminate risks. Right? So, I mean, there are many type of risks. There is technology risk, management risk, product risk. So they make a plan to minimize the risk. And lastly, the venture capitalists. Uh, they are basically any person who works in a venture capital fund is rightfully called a venture capitalist. Now, poll question 6. What is the ideal team size in a $50 million VC fund? 5, 10, 15, 20. Now, you would be thinking $50 million is a big amount. So you need a lot of people to manage it. Actually, that is not true. You need very small people to manage it. So usually it is 10. A team of 10 can easily manage a $50 million VC fund. Now, how to make a career in venture capital and startup ecosystem? First of all, you have to develop your skills. So the skills, like VC firms, they take a lot of CFAs, chartered financial analyst, from the US, those who have done from the US entity. And they also take people who have done MBA from good colleges. They also have a term called entrepreneur in residence. So startup founders who have done something nice in startups, the VC firm guys take them also as entrepreneur in residence. So you need a lot of skills. You need mathematical and analytical skills, business and economic understanding, negotiation, deal making. And the entry point can be pre-MBA. So just before MBA, you can join them, or after the MBA, you can join them, or you can suppose you have a successful startup, you take an exit, you have sold your startup. You can join as a senior executive or partner. or you are a CXO in a corporate. You are a CEO or a CMO or a CRO or a CTO or a CFO. Then you can join the VC funds. Um, no, so you have to plan your degree. I mean, which degree you should take so that you work in a VC fund. So you can be, you can be an expertise in a particular technology. I mean, or an expertise expert in a particular sector. So you have to choose a degree. You can do MBA, or you can choose not to do MBA but to do CA, or with CA you can do a CFA, or with MBA you can do a CFA. So you have to choose. Then, secondly, you have to get an internship, uh, either in investment banking, or consulting, or business development, or sales, or product management. These are the most favorite areas in which you can do an internship, and that experience is beneficial for working in a VC firm. Now, question: what is the most preferred route for those wanting to build a career in venture capital? Is it Ivy League MBA plus being a startup founder? Is it BCom, BSc Economics plus CFA and or MBA? Is it CA plus CS plus law? Or is it engineering plus MTech? So the right answer is the 1, 2, and 3. You can be Ivy League MBA plus X startup founder. A VC firm will consider you, or BCom plus CFA or MBA and or MBA, or you can be a CA plus CS plus law. Now,
Sorry
to
to interrupt sir, but slide I guess एक जगह पे stick हो गई है.
which where has it got stuck?
On slide number 4.
It hasn't moved after 4.
Yes, it is now visible.
No, but you didn't tell me it got stuck at 4. It got stuck at this one.
Yes, sir.
So then I changed so many slides. You didn't tell me then.
Uh, because we are being occupied in listening the thing being told by you.
You missed all these slides. The ones which
Yes.
are. Oh, okay, then let me just finish it. Then 2021 was a pivotal year for the venture capital landscape. Investments in India grew 3.8 times over the last year, and the share of VC funding uh, was more than 50% of overall funding, and 44 unicorns were minted in India. I mean, unicorns are companies which are more than $1 billion. Now, India is home to how many unicorns by end of 2022? Is it 42, 18, 107, and 74? And the right answer is 107 and counting. Okay, so I'm open to questions. This is about the slide, sorry, the presentation. And we have done under 30 minutes, so we are good to go. If you guys have any questions, please feel free to ask me on the chat. And also, you can reach out to me through LinkedIn. I am sharing my LinkedIn profile on chat, so you can reach out to me on LinkedIn also later on. Thank you so much.
So there is one question from the participant Yash. What are the challenges of a venture capital?
Challenges of venture capital is that uh, see, you might have a good sense of the sector, that media sector is like this, financial sector is like this, but end of the day, the sector dynamics also keep on changing. So and also, what 90% of the startups close down after 2 to 3 years, 5 years, and the survival rate is very low. So end of the day, you have to choose amongst the 10% startups which will survive. And so you need to have sector knowledge. You need to have a good understanding about the team, because you're betting on a team. Many founders, when they get VC money, their mind goes off. They start doing all stupid things. Some very few people have done, like Go Mechanic cases there. They were cooking the balance sheet. And so then Ashnil Grover's case is there. So he was doing some funny things, as the VC fund said. So and so from a VC fund point of view, picking the right team, picking the right sector, picking the right market, picking the right business plan, all these things are very important. And also you need to be alert to ensure that the future rounds happen. So you have to do a lot of hand holding. I mean, it is a full-time job. I know funds who have 40 investments, 50 investments. They are busy all the time in looking after the companies. So that is the most challenging part of VC fund.
So another question, as a venture capitalist, do you focus more on the quantitative or on the qualitative?
Uh, See, any VC fund gets 15 to 20 deals a day, new companies. So if you focus on quantity, you will never be able to get the return. You have to focus on quality. And there is a line which many investors say, that don't spray and pray. Don't just put money here, there, invest in 100 companies and then start praying. At the end of the day, there has to be a logic to the madness, a method to the madness. And so, quality is more important than quantity, because out of 10 companies, only 2 companies make it big, really big. So you have to be very focused on finding those 2 companies out of thousands of companies which will come to you. So that is the quality is the main criteria.
Just an add on to that question, may I?
Yeah.
So when we're speaking of quantitatives here, considering specifically of pre-series A or series A rounds, so as an investor, would you focus more on the company company's financials, like has the revenue been growing so far? Is it profitable till this point? Or would you focus more on the team, the founder, and the product market fit, or the qualitative criterias in that sense, or the financials? And I believe it's a mix of both, but what is the main focal point as an investor?
See, you have to focus on almost 12 things. First of all, what is the sector, and are there any headwinds in the sector? Now, today, China is the biggest producer of steel, and you say that I'll be setting up a steel plant in India. I mean, uh, the steel prices keep on changing, and the pricing is in the hands of Chinese suppliers. So, I mean, if you are, that is one thing you're starting with. You're starting with the sector, and are there any headwinds in the sector? So, for example, COVID came, and the online education companies, the edtech companies, they got headwinds. When demonetization came, then payment companies like Paytm got the headwind. So China, gaming was very strong, and outside school tutoring was strong. Now the government clamped down on both these sectors. So the headwinds have gone out of the sector. So one is the headwind. Second, the company in which you are investing, what is the performance of the company till now? So, if the company is pre-revenue, then you don't have a way to check the performance, but you do have a way to check the product, that the product which they have created, how does it look like, whether it is working or not. If you don't have the luxury of seeing that also, then you check the founders. You are betting on the horses, the founders. Then you check the founders, how good are they, whether they'll be able to change the product, and the business plan, if need be. Will they be able to pivot? Thirdly, market size. If you are investing in a company which operates in a 50 crore market, the company can only grow till 20-25 crore turnover, right? Even if it takes 50% of the market. So I know, like Matrix Partners, they do not invest in companies which have less than $5 billion of market size. So that is the market. Then competition. Uh, Paytm used to think it's the biggest payment platform, and it ignored UPI when UPI came. And suddenly, PhonePe, which is owned by Flipkart, Walmart, and Google Pay, they sensed an opportunity and they went for the kill. And now they have more than 80% combined, 80% volume of the UPI transactions, and Paytm got left behind. So competition is very important because you are existing in an ecosystem. And what are your competitive advantages that you will survive the competition? Because the competition might also have deep pockets. So that is one. And then what is the projections? What is the business you are likely to do? How are you going to stay true on unit economics? Meaning making money on each unit of sale. And then what is the team? And So all those things. And how much funds the company is asking for. I have seen companies, sir, we are pre-revenue, give us 80 crores. So I mean, end of the day, the company raises funding for 12 to 18 months. Why do you need 80 crores? At this level, early stage, pre-revenue, if you want 80 crores, then are you ready to give 100% of the company, even if that is possible? So, raise only that amount of money which you can deploy in 12 to 18 months. Otherwise, you are diluting too much equity. So, and the use of funds. How will you use the funds? That is the most important. So, all these things are important. Having a technology core is very important nowadays. And having an intellectual property also becomes very important. So, if there is, it is a, so if you apply for IIT and if you apply for IAS, it is a negative decision, right? They are chucking out 99.99% of the people. So they are saying no. They are not saying yes easily. So VC investment is like that. 99% times you'll have to say no, 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 no. When all the things click, then only you have to bother about, now let me think which value at which I should get in, and what is the structure I should do. Till that time, till you are not satisfied in all the parameters, it is no, no, no. So that is how the VC fund operates.
Understood. Thank you so much.
Thank you.
Sir, another question is, what are the scope and uses of venture capital?
Scope and uses of venture capital means like everybody needs new products and services. Everybody needs it faster. Everybody needs assurance of the quality. Everybody needs that if the product or service is not good, I should get a refund. Everybody needs a right channel through which they can easily buy that product or service. So Amazon was started in 1994 with the one line theory, or rather one line belief, that people need money at their home, they need it faster, and they need of the right quality. And that thing has stayed true till date. Till today, it is true. So if you are able to pamper the consumer, then the consumer will buy from you. And that's what creates the market. And you have to do it in a way intelligently in which you make money also. So So that is the scope of venture capital. All of the apps which you use nowadays, they are backed by venture capital. Flipkart, Amazon, Facebook, uh, Make My Trip, uh, Daily Hunt, uh, you know, this one, Zomato, Swiggy, Paytm, Google Pay, Phone Pay. Uh, all these companies, were able to take risks and create something better for the customer because they got access to venture capital. And in that process, they also became big, and venture capital also earned a lot. So venture capital is the risk taking guy who takes a measured risk, and that's where he gets the return also.
Then how to develop as an financial expert?
Sorry.
How to develop as an financial
Financial
expert?
expert. See, you can do courses like, Wall Street School is there in Delhi. They teach you financial modeling, and there are now lot of edtech courses are there. Uh, this is a very practical learning. Like, to be a finance experts, it is very practical learning. You have to sit on a Excel sheet, create a company's business plan, a financial model, see how the numbers are working, where cost can be cut, where revenue can be increased, and doing each action, how is it resulting in change in the value of the company, how is it resulting in change to the free cash flows of the company. So it's a very practical kind of knowledge, and CAs, they have a lot of knowledge about how the tax system works, how the financial model will have various things which are impacted by the regulations. And but it's a very practical thing, and if you need to develop right expertise, I suggest you work for a big four company. Work for Deloitte, PricewaterhouseCoopers, KPMG, or Ernst and Young. Or after the big four, there are Grant Thornton, BDO. So you can work for those companies. Working for even 2 to 3 years in any such company will give you a right handle on all the laws, all the regulations, compliances, financial modeling, how to present uh, the the management things, and so my sense is like working in a practical way in a good corporate teaches you more than uh, finding out in book and starting reading to start to read it. So that is my advice to you.
How can we be professional finance of ourselves?
I didn't get you, Shivani. Financial, how can?
How can we be professional finance of ourselves?
Acha, how can you, okay, be professionals in finance yourself? Uh, Maybe you can you can work with a company which creates financial models, or you can work with a CA firm. So they will give you a good experience. You can work as an article or a assistant, or then later on you can open your own firm. You will get a lot of business projects, and then you can form a handle on that. Or secondly, uh, you can create your own startup. So once you'll do the math on an Excel sheet, you will start appreciating it much more, how these models work. And on the financial knowledge side, let me tell you, with Google and the edtech companies, the huge number of them nowadays, content is freely available. You should be willing to sit on a laptop, find out on Google. Maybe you need to buy a small course like 500 rupees or 1000 rupees. You can buy a video course also. Content is there. You the only thing is you should be willing to learn that.
Sir, there is one question that my friend daughter is a graduate and want to get into venture capitalist role, but no organization is shortlisting her profile, mentioning she is underqualified. So, what should she do in such situation?
She has to clear a CFA, or she has to do MBA from a good place, or she has to have a startup experience where she has worked in startup fundraising for at least 2 to 3 years. Then, if the startup is doing well, then they can always tell the VC that we have real experience. And the best way is, as I told you in the presentation, also CS, CA, CFA, MBA Finance. CFA is very advisable.
Okay. Dear participants, you can unmute yourself if you have any other question.
Anshika has some.
I have another question. Like you mentioned that the VCs mostly have a preferred sector in mind, and that's where they mostly eye companies that have possibly a good product in that sector. So, for example, while VCs were focusing on companies like Paytm and digital payment companies after the demonetization, so provided that mostly the typical duration of uh, a fund when they expect the return to happen is 10 years. So, if that happened to be a trend which sustained for 10 years and people actually shifted towards digital payment, but provided industries like health tech or maybe the trend that we observed during COVID, so that did not sustain for long. So my question here is that the trend based sector favoritism, in your experience, has it been actually favorable in your case? Has the trend sustained for 10 years? Or like there are cases where that approach has failed also?
See, I mean, you are very right. I mean, as I told you, it's not easy to be a VC, because end of the day you are betting your whole uh, corpus onto companies which are very risky. And as you rightly said, the sector also keeps on shifting. So what companies like us do is that we keep some monies on the sideline for the follow-on investment rounds of our portfolio companies. So K Capital, Mr. Sasha Mirchandani, Bombay, the guy who belongs to the Onida family, they invest up to $1 million round, and then they keep $1 million separately for the future rounds, because VCs have a very nagging habit. They say that somebody else should take the risk first. If somebody else has given a term sheet or given a commitment, then we will think of coming in. So they always invest in hordes because they want to minimize the risk. So keeping money separately is one. Uh, then uh, uh, then always, when two VCs meet, they open their menu and they start discussing the menu. I have these investments. The other person says, I have these investments. You put in my company. In the future round, I put in your company. So they try and de-risk by these ways, by these methods. And always remember that any investment which is equity investment, it works in a portfolio approach. And the portfolio approach means that out of 10 investments, one or two will shut down, four or five will be average, they will not grow much, but only one or two will grow 100 times. So you have to make return on those two. Now, many investors, they make the mistake, I had 10 investments two of them are doing well. Let me sell those two and keep the other eight. But the VC, the smart VC, will always never sell the top two investments and keep on betting on them that they grow more, they grow more. He will double down on them, put more money, because वहीं से return आएगा. The return will come from those two only. So that is the thing. And markets have been very benign since 2008. A lot of money is available in the market, and that is why everybody is benefiting from that liquidity. But in the last 1 year, things have become tightened, and we are seeing a funding winter which is going on. So money has become tight. So that is why smart VCs, they are not investing in new companies, but they are keeping money for their old investments. I hope I answered you.
Yeah, absolutely. Thanks a lot.
Thank you.
That's it, sir.
Okay, thank you so much. You can share the video with me, Shivani.
Yes, I'm going to share the video with you.
Okay, thank you so much, all of you. Thank you for coming. My LinkedIn profile is on the chat, and feedback form do fill in. Shivani, please share the feedback with me once it is there with you.
Sure, sir.
Thank you so much, all of you. Have a good day.